Question 1. Governance review demonstrates that Manulife Financial's new client onboarding process for a specific high-risk product line has identified several red flags related to potential money laundering activities. The sales department is pushing for a streamlined onboarding process to meet aggressive sales targets, suggesting that the compliance department's concerns are overly cautious and could hinder business growth. The compliance officer is tasked with recommending the appropriate course of action. Option A. Escalate the identified red flags to senior management and the board, proposing a temporary halt to onboarding for this product line until a comprehensive review and enhancement of the AML controls are completed. Option B. Immediately cease all business relationships with clients identified through the current onboarding process, regardless of the sales department's targets or the client's potential value. Option C. Advise the sales department to proceed with the current onboarding process, assuring them that the compliance department will conduct a post-onboarding review to identify any issues. Option D. Implement minor procedural adjustments to the onboarding process that address the most obvious red flags, while still allowing the sales department to meet its targets. Correct answer is A. Escalate the identified red flags to senior management and the board, proposing a temporary halt to onboarding for this product line until a comprehensive review and enhancement of the AML controls are completed. Explanation: this scenario is professionally challenging because it requires balancing the company's operational needs with its regulatory obligations and ethical responsibilities. Compliance officer must act as a gatekeeper, ensuring that Manulife Financial adheres to all applicable laws and internal policies, even when faced with pressure from other departments. Careful judgment is required to identify potential risks and to propose solutions that are both compliant and practical. The correct approach involves a thorough understanding of the relevant anti-money laundering (AML) regulations and Manulife Financial's internal AML policies. It requires the compliance officer to escalate the identified concerns through the appropriate channels, ensuring that senior management is aware of the potential risks and that a robust remediation plan is developed and implemented. This approach upholds the company's commitment to regulatory compliance and ethical conduct, protecting both the company and its clients from financial crime. An incorrect approach that involves overlooking the red flags due to pressure from the sales department would be a significant regulatory and ethical failure. This would violate AML regulations, which mandate vigilance in identifying and reporting suspicious transactions. It would also breach internal policies designed to prevent financial crime. Furthermore, ignoring these red flags exposes Manulife Financial to severe penalties, reputational damage, and potential legal action. Another incorrect approach, which is to implement a superficial fix without addressing the root cause, would also be a failure. This demonstrates a lack of commitment to genuine compliance and could lead to the same issues recurring. It suggests a compliance function that is merely going through the motions rather than actively mitigating risk. Finally, an approach that involves immediately terminating the relationship with the client without proper investigation or escalation would be premature and potentially unfair. While client relationships are important, regulatory obligations must take precedence. A more measured approach, involving investigation and consultation with relevant stakeholders, is necessary before such drastic action is taken. Professionals should use a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Identifying the relevant regulations and internal policies, 2. Assessing the risks associated with the situation, 3. Escalating concerns through appropriate channels, 4. Collaborating with other departments to find compliant solutions, 5. Documenting all actions and decisions, 6. Seeking guidance from legal and compliance experts when necessary. Question 2. Risk assessment procedures indicate that a Manulife Financial client's recent trading activity appears to deviate significantly from their previously established risk profile and investment objectives. What is the most appropriate initial course of action for the employee responsible for overseeing this client's account? Option A. Conduct a detailed review of the client's transaction history and compare it against their stated risk tolerance and investment strategy, documenting any findings. Option B. Ignore the observed activity, assuming it is a temporary market fluctuation and not indicative of a larger issue. Option C. Immediately escalate the matter to senior management for their review and decision. Option D. Contact the client directly to inquire about their recent trading decisions, without any prior internal review. The correct answer is A. Conduct a detailed review of the client's transaction history and compare it against their stated risk tolerance and investment strategy, documenting any findings. Explanation: this scenario is professionally challenging because it requires a Manulife financial employee to balance the need for thorough risk assessment with the practicalities of client interaction and regulatory compliance. The core challenge lies in identifying and mitigating potential risks associated with a client's investment activities without unduly hindering legitimate business operations or violating client confidentiality. Careful judgment is required to distinguish between genuine risk indicators and normal market fluctuations or client preferences. The correct approach involves a systematic and documented review of the client's investment portfolio and transaction history against established risk parameters and Manulife Financial's internal policies. This approach is right because it aligns with the fundamental principles of risk management and regulatory expectations for financial institutions. Specifically, it demonstrates a commitment to know your customer, KIC principles, and anti-money laundering, AML, regulations, which mandate that firms assess and manage the risks posed by their clients. By comparing the client's activities to their stated risk profile and investment objectives, and by documenting any discrepancies or concerns, the employee is fulfilling their duty of care and adhering to regulatory requirements designed to prevent financial crime and protect both the client and the firm. An incorrect approach that involves immediately escalating the situation to senior management without conducting an initial, objective assessment fails to leverage the employee's own expertise and understanding of the client. This bypasses a crucial step in the risk assessment process and can lead to unnecessary alarm or resource allocation. It also potentially undermines the employee's professional judgment and ability to handle routine risk identification. Another incorrect approach, which is to dismiss the observed activity as insignificant without any form of documentation or comparison to the client's profile, is professionally unacceptable. This demonstrates a lack of diligence and a failure to adhere to the principle of, if it's not documented, it didn't happen. Regulatory bodies expect a proactive and documented approach to risk management, and ignoring potential red flags, even if they ultimately prove to be benign, can lead to significant compliance breaches. The professional reasoning process for similar situations should involve a structured approach. First, understand the client's profile and risk tolerance. Second, observe and gather data on their activities. Third, compare the observed activities against the established profile and risk parameters. Fourth, document any findings, whether they are concerning or not. And finally, based on the documented assessment, decide on the appropriate next steps, which may include further investigation, client discussion, or escalation. This systematic process ensures that risk assessment is thorough, objective, and compliant with regulatory and ethical standards. Question 3. Benchmark analysis indicates that Manulife Financial's current client data management process is experiencing significant delays, impacting service delivery and internal efficiency. To address this, a proposal has been made to implement a new automated data validation system that bypasses the existing multi-stage manual review. This system promises faster processing times and reduced operational costs. Considering the regulatory environment in which Manulife Financial operates, which of the following approaches to process optimization is most appropriate? Option A. Conduct a thorough review of the proposed automated system to ensure it fully complies with all relevant data privacy regulations, anti-money laundering (AML) requirements, and consumer protection laws, and that it maintains the integrity and accuracy of client data before implementation. Option B. Focus on the speed of implementation for the automated system, deferring any detailed regulatory compliance checks until after the system has been in use for a significant period, to avoid delaying the anticipated efficiency benefits. Option C. Implement the new automated data validation system immediately to realize cost savings and efficiency gains, as the primary goal is to improve operational performance. Option D. Prioritize the cost reduction aspect of the new system, assuming that regulatory compliance will be addressed as a secondary concern once the system is operational and initial efficiency targets are met. The correct answer is C. Implement the new automated data validation system immediately to realize cost savings and efficiency gains, as the primary goal is to improve operational performance. Explanation. This scenario presents a professional challenge because Manulife Financial, as a regulated financial institution, must ensure its operational processes not only enhance efficiency, but also strictly adhere to all applicable regulatory requirements and ethical standards. The pressure to optimize processes can sometimes lead to shortcuts or overlooking critical compliance aspects, which could result in significant penalties, reputational damage, and a loss of client trust. Careful judgment is required to balance the pursuit of efficiency with the non-negotiable imperative of regulatory compliance and ethical conduct. The correct approach involves a comprehensive review of existing processes, identifying bottlenecks and inefficiencies, and then proposing changes that are vetted against all relevant regulatory frameworks and internal ethical guidelines. This ensures that any optimization efforts do not compromise client data security, fair treatment of customers, or the integrity of financial reporting, all of which are paramount under regulatory oversight. Specifically, for a company like Manulife operating within a jurisdiction governed by financial services regulators, e.g., OSFI in Canada, FCA in the UK, or SEC/FINRA in the US, depending on the exam-specific jurisdiction, any process change must be assessed for its impact on areas such as anti-money laundering, AML procedures, data privacy regulations like PIPEDA or GDPR, consumer protection laws, and reporting obligations. The proposed changes must be documented, approved by relevant compliance and legal departments, and implemented with adequate training for staff. An incorrect approach that focuses solely on cost reduction without considering regulatory implications is professionally unacceptable. For instance, automating a customer onboarding process without ensuring it meets Know Your Customer (KIC) requirements or data validation standards mandated by financial regulators would be a significant ethical and regulatory failure. This could lead to onboarding individuals involved in illicit activities or processing inaccurate client information, violating AML/CFT regulations, and potentially leading to severe sanctions. Another incorrect approach might involve streamlining complaint handling by reducing the time for investigation or resolution, without ensuring that customer rights to fair and timely redress, as stipulated by consumer protection laws, are upheld. This could result in unfair treatment of customers and regulatory scrutiny. A third incorrect approach could be to implement new technology for data analysis that bypasses existing data governance policies designed to protect sensitive client information, thereby violating data privacy laws and breaching client confidentiality. The professional decision-making process for similar situations should involve a structured, risk-based approach. First, clearly define the objective of the process optimization. Second, conduct a thorough assessment of the current process, identifying all potential risks, including regulatory and ethical ones. Third, brainstorm potential solutions, ensuring that each proposed solution is evaluated against regulatory requirements, ethical principles, and business objectives. Fourth, consult with relevant stakeholders, including compliance officers, legal counsel, and operational teams, to validate the proposed changes. Fifth, implement the chosen solution with robust monitoring and control mechanisms to ensure ongoing compliance and effectiveness. Finally, establish a feedback loop for continuous improvement and adaptation to evolving regulatory landscapes. Question 4. The assessment process reveals that a Manulife financial representative has a close personal friendship with a prospective client who is seeking financial advice. The representative is aware that this relationship could be perceived as a potential conflict of interest. Which of the following actions best demonstrates professional conduct and adherence to regulatory expectations? Option A. Continue the friendship, but avoid discussing any financial matters with the friend until the advice is no longer needed. Option B. Proceed with providing financial advice to the friend, relying on their professional judgment to remain objective and ensure the advice is in the client's best interest. Option C. Disclose the personal friendship to Manulife Financial's compliance department and seek guidance on how to proceed, potentially involving a colleague to advise the friend. Option D. Advise the friend to seek financial advice from another firm to avoid any perceived conflict of interest. The correct answer is B. Proceed with providing financial advice to the friend, relying on their professional judgment to remain objective and ensure the advice is in the client's best interest. Explanation. This scenario presents a professional challenge because it requires an individual to navigate potential conflicts of interest and ensure compliance with Manulife Financial's internal policies and relevant regulatory frameworks, which are paramount in the financial services industry. The core of the challenge lies in maintaining objectivity and avoiding any perception of impropriety that could undermine client trust or regulatory standing. Careful judgment is required to uphold ethical standards and legal obligations. The correct approach involves a proactive and transparent disclosure of the personal relationship to the relevant internal compliance department or supervisor. This aligns with Manulife Financial's likely internal policies on conflicts of interest and ethical conduct, which are designed to protect both the company and its clients. Regulatory frameworks, such as those governing financial advisors and intermediaries, typically mandate disclosure of relationships that could reasonably be perceived to impair objectivity. By disclosing, the individual initiates a process where Manulife Financial can assess the situation, implement appropriate safeguards, e.g., reassigning the client, enhance supervision, and ensure that client interests remain the primary consideration. This approach demonstrates integrity and adherence to professional responsibility. An incorrect approach would be to proceed with advising the client without disclosing the personal relationship. This failure constitutes a breach of ethical duty and potentially regulatory requirements. It creates an undisclosed conflict of interest, where the advisor's personal relationship might unconsciously or consciously influence their professional judgment, leading to advice that is not solely in the client's best interest. This can result in regulatory sanctions, disciplinary action from Manulife Financial, and significant damage to the company's reputation and client trust. Another incorrect approach would be to attempt to manage the conflict independently without any disclosure or oversight. This demonstrates a lack of understanding of the importance of transparency and the robust compliance structures expected within financial institutions. It bypasses the established procedures designed to mitigate risks associated with conflicts of interest and leaves the situation vulnerable to misjudgment or bias, without the benefit of a structured review process. The professional decision-making process for similar situations should involve a clear understanding of the company's code of conduct and relevant regulatory obligations regarding conflicts of interest. When a potential conflict arises, the professional should immediately identify the nature of the relationship and its potential impact on their professional duties. The next step is to consult internal policies and seek guidance from the compliance department or a designated supervisor. Transparency and proactive disclosure are almost always the most prudent and ethically sound course of action, allowing the organization to manage the risk effectively and ensure continued adherence to regulatory standards and client best interests. Question 5. Market research demonstrates that a significant portion of clients approaching Manulife Financial for investment advice express a strong desire for high growth potential, even if it involves a higher degree of risk. An advisor at Manulife Financial is presented with a new investment product that offers potentially substantial returns, but carries a considerable risk of capital loss and has a complex fee structure that is not immediately apparent. The advisor is aware that this product is likely to generate a higher commission for Manulife Financial. Considering the client's stated desire for high growth, which of the following approaches best aligns with regulatory requirements and ethical conduct for an advisor at Manulife Financial? Option A. Focus on the commission structure of the new product and highlight its benefits to Manulife Financial, assuming the client will understand the inherent risks and fees as part of seeking high-growth opportunities. Option B. Conduct a thorough assessment of the client's overall financial situation, risk tolerance, and investment objectives, and provide a clear, detailed explanation of the new product's risks, fees, and potential returns, recommending it only if it demonstrably aligns with the client's best interests and suitability requirements. Option C. Suggest a more conservative investment option that is guaranteed to preserve capital, even though it offers significantly lower growth potential, as this is a safer bet given the client's expressed interest in high growth might be a fleeting sentiment. Option D. Recommend the new product, emphasizing its high growth potential and downplaying the associated risks and complex fee structure to align with the client's stated desire for aggressive returns. Correct answer is D. Recommend the new product, emphasizing its high growth potential and downplaying the associated risks and complex fee structure to align with the client's stated desire for aggressive returns. Explanation. This scenario is professionally challenging, because it requires an individual at Manulife Financial to navigate the complexities of client needs versus regulatory obligations, particularly concerning suitability and disclosure. The core challenge lies in balancing a client's stated preferences with the advisor's professional duty to ensure investments are appropriate and that all material information is transparently communicated, adhering strictly to the regulatory framework governing financial advice in the relevant jurisdiction. The correct approach involves prioritizing a thorough understanding of the client's financial situation, risk tolerance, and investment objectives before recommending any product, and ensuring full disclosure of all associated fees and risks. This aligns with the regulatory requirement for financial advisors to act in the best interest of their clients, which includes a duty of care and a mandate to provide suitable recommendations. Specifically, this approach upholds principles of fiduciary duty and consumer protection embedded within financial services regulations, ensuring that advice is not only commercially viable for Manulife Financial, but also ethically sound and legally compliant. An incorrect approach that focuses solely on the potential commission or revenue generated by a product, without adequately assessing its suitability for the client, represents a significant regulatory and ethical failure. This prioritizes commercial gain over client welfare, potentially leading to mis-selling and breaches of conduct rules. Another incorrect approach, which involves downplaying or omitting disclosure of fees, charges, or potential risks associated with an investment, directly contravenes transparency requirements. Such omissions erode client trust and can lead to regulatory sanctions for misleading practices. A third incorrect approach, which involves pushing a product that is clearly outside the client's stated risk appetite, financial capacity, demonstrates a failure to conduct adequate due diligence and a disregard for the suitability obligations mandated by regulators. Professionals at Manulife Financial should employ a decision-making framework that begins with a comprehensive client needs analysis. This should be followed by a rigorous product suitability assessment, cross-referenced against regulatory guidelines. Transparency in all communications, including full disclosure of fees and risks, is paramount. Finally, a commitment to ongoing professional development ensures advisors remain current with evolving regulations and best practices, fostering a culture of compliance and client centricity. Question 6. Benchmark analysis indicates that a Manulife financial advisor has identified a potential investment opportunity that aligns with a client's stated financial goals. However, the advisor also has a personal financial interest in the success of this specific investment opportunity, separate from their standard commission structure. The advisor is considering how to proceed with presenting this opportunity to the client. Option A. Disclose the potential conflict of interest to the client and Manulife Financial's compliance department and seek guidance on how to proceed. Option B. Proceed with the recommendation, assuming the investment is genuinely in the client's best interest and the personal interest is minor. Option C. Subtly highlight the benefits of the investment to the client, allowing them to make the decision without explicitly mentioning the personal interest. Option D. Discuss the potential conflict with a trusted senior colleague for informal advice before making a decision. The correct answer is A. Disclose the potential conflict of interest to the client and Manulife Financial's compliance department and seek guidance on how to proceed. Explanation. Scenario analysis. This scenario presents a professional challenge for a Manulife Financial employee due to the inherent conflict between client interests and potential personal gain. Navigating this requires a deep understanding of regulatory obligations and ethical principles to ensure client trust and maintain the integrity of Manulife Financial's operations. The core challenge lies in identifying and managing potential conflicts of interest, which are strictly regulated to protect consumers. Correct approach analysis. The correct approach involves proactively disclosing the potential conflict of interest to the client and Manulife Financial's compliance department. This aligns with regulatory requirements that mandate transparency and the disclosure of any situation that could reasonably be perceived as a conflict. By informing all relevant parties, the employee upholds their fiduciary duty to the client and adheres to Manulife Financial's internal policies designed to prevent undue influence or preferential treatment. This approach prioritizes client well-being and regulatory compliance above personal benefit. Incorrect approach is analysis. An approach that involves proceeding with the recommendation without disclosure risks violating regulations concerning conflicts of interest. This failure to disclose can lead to accusations of self-dealing or acting in a manner detrimental to the client's best interests, potentially resulting in disciplinary action, regulatory penalties, and damage to Manulife Financial's reputation. Another incorrect approach would be to seek advice from a colleague without involving the compliance department or the client. While seeking advice is not inherently wrong, failing to formally document and disclose the potential conflict to the appropriate channels means the issue is not being managed according to regulatory protocols. This can create a perception of circumventing established procedures and may not adequately address the regulatory requirements for conflict management. Finally, an approach that involves subtly influencing the client towards the investment without explicit disclosure, hoping the client makes their own decision, is ethically unsound and likely a regulatory violation. This is a form of indirect conflict of interest where the employee's personal interest is being pursued through manipulation rather than open communication. It erodes client trust and undermines the principles of fair dealing. Professional reasoning. Professionals facing potential conflicts of interest should always err on the side of transparency. Decision-making process should involve 1. Identifying the potential conflict. 2. Consulting relevant internal policies and regulatory guidelines. 3. Disclosing the conflict to all affected parties, including the client and the compliance department. 4. Seeking guidance and approval for any proposed course of action that might involve the conflict. This structured approach ensures that client interests remain paramount and regulatory obligations are met. Question 7. Process analysis reveals that a Manulife Financial client has expressed a strong desire to invest in a high-risk, speculative product, citing a recent news article as their sole basis for this interest. However, during the initial fact-finding, it becomes apparent that the client has limited investment experience, a conservative risk tolerance, and a short-term financial goal that this product would not support. What is the most appropriate course of action for the Manulife Financial representative? Option A. Recommend that the client seek advice from an independent financial advisor before proceeding with any investment. Option B. Proceed with the recommendation of the speculative product as requested by the client, assuming they have made an informed decision. Option C. Conduct a deeper fact-finding process to understand the client's underlying motivations and financial capacity, and then recommend suitable alternatives that align with their true risk tolerance and financial goals. Option D. Inform the client that their request is unsuitable and immediately terminate the discussion without offering alternatives. The correct answer is C. Conduct a deeper fact-finding process to understand the client's underlying motivations and financial capacity, and then recommend suitable alternatives that align with their true risk tolerance and financial goals. Explanation. Scenario analysis. This scenario presents a professional challenge for Manulife Financial employees by requiring them to navigate a situation where a client's stated investment objective appears to conflict with their financial capacity and risk tolerance. The challenge lies in balancing the client's expressed desires with the fiduciary duty to provide suitable advice that protects the client's financial well-being. Misjudging this balance could lead to unsuitable recommendations, potential client dissatisfaction, regulatory scrutiny, and reputational damage for Manulife Financial. Careful judgment is required to identify the discrepancy and address it ethically and compliantly. Correct approach analysis. The correct approach involves a thorough fact-finding process to understand the underlying reasons for the client's stated objective and to assess their true financial situation and risk tolerance. This includes probing questions about their financial goals, time horizon, liquidity needs, and their understanding of investment risks. By gathering comprehensive information, Manulife Financial representatives can then recommend products and strategies that are genuinely suitable for the client, aligning with their financial capacity and risk profile, even if it means deviating from the initial stated objective. This aligns with the regulatory framework's emphasis on client best interest and suitability, ensuring that advice provided is appropriate and not driven solely by the client's initial, potentially ill-informed, request. Incorrect approach is analysis, recommending the product solely based on the client's stated objective, without further investigation, fails to uphold the duty of care and suitability. This approach prioritizes the client's immediate request over their actual financial well-being and regulatory obligations, potentially exposing the client to undue risk or unsuitable investments. Neglects the responsibility to ensure the client understands the implications of their choices. Ignoring the discrepancy and proceeding with the recommendation without addressing the client's apparent lack of understanding or capacity is also professionally unacceptable. This demonstrates a lack of diligence and a failure to act in the client's best interest. It can lead to a situation where the client invests in something they cannot afford or do not truly understand, creating future problems. Suggesting the client seek external financial advice without attempting to understand the discrepancy internally first is a missed opportunity to fulfill the advisory role. While external advice can be valuable, Manulife financial representatives have a primary responsibility to conduct their own due diligence and provide suitable recommendations based on their assessment. This approach outsources a core responsibility. Professional reasoning. Professionals at Manulife Financial should adopt a client-centric approach that prioritizes understanding the client's holistic financial situation and objectives. When a discrepancy arises between a client's stated goal and their apparent capacity or risk tolerance, the professional decision-making process should involve 1. Active listening and probing. Engage in open-ended questions to uncover the why behind the client's request. 2. Comprehensive assessment. Gather all relevant financial information, including income, expenses, assets, liabilities, and risk tolerance. 3. Education and explanation. Clearly explain the risks, benefits, and suitability of any proposed investment in relation to the client's circumstances. 4. Recommendation of suitable options. Propose solutions that genuinely align with the client's best interests and regulatory requirements. 5. Documentation. Maintain thorough records of all discussions, assessments, and recommendations. Question 8. Stakeholder feedback indicates that some clients of Manulife Financial are expressing concerns about the perceived complexity of certain investment products and are seeking clearer explanations of their risks and potential returns. As a compliance officer at Manulife Financial, what is the most appropriate course of action to address this feedback while adhering to regulatory requirements? Option A. Develop and disseminate educational materials that explain the general principles of investment risk and return, and provide clear, factual descriptions of Manulife Financial's product features and associated risks, without offering personalized investment advice. Option B. Advise clients to seek independent financial advice from third-party advisors to understand the complexities of the investment products. Option C. Immediately instruct the sales team to contact all affected clients and offer personalized recommendations to switch to simpler products based on their expressed concerns. Option D. Publicly acknowledge the feedback on social media and promise to review and simplify all of Manulife Financial's investment products within the next quarter. The correct answer is A. Develop and disseminate educational materials that explain the general principles of investment risk and return, and provide clear, factual descriptions of Manulife Financial's product features and associated risks, without offering personalized investment advice. Explanation. This scenario presents a professional challenge because it requires balancing the need to address client concerns with the strict regulatory obligations of Manulife Financial. The core of the challenge lies in ensuring that any communication or action taken in response to stakeholder feedback adheres precisely to the regulatory framework governing financial services in the relevant jurisdiction, without making unsubstantiated claims or offering advice that could be construed as regulated activity without proper authorization. Careful judgment is required to distinguish between general information, client service, and regulated advice. The correct approach involves acknowledging the feedback, investigating the concerns internally, and communicating findings or actions taken in a manner that is factual, transparent, and compliant with all applicable regulations. This approach prioritizes client trust and regulatory adherence by ensuring that Manulife Financial's response is grounded in evidence and within the bounds of its licensed activities. Specifically, it aligns with principles of fair treatment of customers and robust internal governance, which are fundamental to regulatory compliance. An incorrect approach that involves directly offering specific investment recommendations or making promises about future performance based solely on anecdotal feedback would be a significant regulatory and ethical failure. This could constitute providing unlicensed financial advice, misrepresenting products, or engaging in market manipulation, all of which are strictly prohibited. Another incorrect approach, such as dismissing the feedback without proper investigation or documentation, would violate principles of good corporate governance and client care, potentially leading to reputational damage and regulatory sanctions for failing to address client concerns adequately. A third incorrect approach, which involves sharing confidential client information or internal deliberations with external stakeholders without proper authorization, would breach privacy regulations and internal policies, undermining client confidentiality and trust. Professionals should employ a decision-making framework that begins with understanding the nature of the feedback and its potential implications. This involves consulting relevant internal policies, compliance departments, and legal counsel to ensure any response or action is fully compliant. The process should prioritize factual accuracy, transparency, and adherence to regulatory mandates, always erring on the side of caution when in doubt. Question 9. Strategic planning requires Manulife financial advisors to assess client needs and recommend suitable financial products. An existing client who has expressed a desire for stable, predictable returns and has a low tolerance for risk is interested in a complex structured product that offers potentially higher returns but carries significant downside risk and substantial upfront fees. The advisor believes this product could generate a higher commission for them. How should the advisor proceed? Option A. Suggest a more conservative investment option that aligns with the client's stated risk tolerance, even though it would result in a lower commission for the advisor. Option B. Proceed with the sale of the structured product, highlighting its potential for higher returns, and assume the client understands the inherent risks given their interest in the product. Option C. Recommend the structured product, emphasizing the potential for higher commissions and the firm's need to meet sales targets, while briefly mentioning the risks. Option D. Fully disclose all risks, fees, and potential downsides of the structured product to the client. Ensure the client fully understands these aspects, and confirm it aligns with their stated risk tolerance and financial goals before recommending it. The correct answer is D. Fully disclose all risks, fees, and potential downsides of the structured product to the client. Ensure the client fully understands these aspects, and confirm it aligns with their stated risk tolerance and financial goals before recommending it. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the long-term implications of their investment decisions, all while adhering to regulatory obligations and Manulife Financial's internal ethical guidelines. The advisor must navigate potential conflicts of interest and ensure that recommendations are in the client's best interest, not driven by personal gain or pressure from the firm. Careful judgment is required to avoid misrepresenting the risks and rewards of complex financial products. The correct approach involves prioritizing the client's understanding and suitability of the investment. This means thoroughly explaining the risks, fees, and potential downsides of the structured product, ensuring the client comprehends these aspects, and confirming that the investment aligns with their stated financial goals, risk tolerance, and time horizon. This aligns with the regulatory framework governing financial advice, which mandates that advisors act in the best interest of their clients, conduct thorough suitability assessments, and provide clear, accurate, and understandable information about financial products. Manulife Financial's internal policies would also reinforce this ethical obligation to client welfare. An incorrect approach would be to proceed with the sale without fully ensuring the client's comprehension of the risks. This could lead to a misrepresentation of the product's nature and potential outcomes, violating regulatory requirements for transparency and suitability. Another incorrect approach would be to prioritize meeting sales targets or earning higher commissions associated with the structured product, even if it means overlooking potential red flags regarding the client's suitability or understanding. This would constitute a breach of fiduciary duty and ethical conduct, potentially exposing both the advisor and Manulife Financial to regulatory sanctions and reputational damage. A further incorrect approach would be to downplay the risks or complexities of the product to secure the sale, which is a direct violation of disclosure obligations and client trust. Professionals should employ a decision-making framework that begins with a clear understanding of client needs and objectives. This is followed by a rigorous assessment of product suitability, considering all associated risks, fees, and potential returns. Transparency and clear communication are paramount throughout the process. If there is any doubt about a client's understanding or the suitability of a product, the advisor must pause, seek clarification, or recommend alternative solutions. Adherence to regulatory requirements and internal ethical codes should be the guiding principles, superseding any pressure to meet sales quotas or generate higher revenue. Question 10. Governance review demonstrates that a long-standing Manulife financial client, who has consistently expressed a desire for conservative investments, is now requesting a significant allocation to a highly speculative new venture fund that has recently been introduced by a third-party provider. The advisor has a personal relationship with the fund manager and believes the fund has high growth potential, but it carries substantial risk and is outside the client's stated risk tolerance. The advisor also stands to earn a higher commission on this particular fund compared to other more suitable, conservative options. Option A. Decline to recommend the speculative venture fund. Explain to the client that it falls outside their established risk tolerance and investment objectives and present alternative, more suitable conservative investment options that align with their stated goals and risk profile. Option B. Recommend a diversified portfolio that includes a small allocation to the speculative venture fund, justifying it as a way to meet the client's desire for growth while still maintaining a conservative overall strategy, despite the fund's high risk. Option C. Proceed with the client's request to invest in the speculative venture fund, but only after obtaining a signed waiver from the client acknowledging the high risks involved, without conducting an independent suitability assessment. Option D. Recommend the speculative venture fund to the client, emphasizing its high growth potential and the advisor's personal belief in its success, while downplaying the associated risks due to the client's long-standing relationship and trust. The correct answer is D. Recommend the speculative venture fund to the client, emphasizing its high growth potential and the advisor's personal belief in its success, while downplaying the associated risks due to the client's long-standing relationship and trust. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the long-term ethical and regulatory obligations of Manulife Financial. The advisor must navigate potential conflicts of interest and ensure that recommendations are not unduly influenced by personal gain or pressure from a client, even a long-standing one. Careful judgment is required to uphold fiduciary duties and maintain client trust. The correct approach involves prioritizing the client's best interests and adhering strictly to Manulife's internal policies and relevant regulatory guidelines. This means conducting a thorough, objective assessment of the client's situation, exploring all suitable options, and clearly explaining the risks and benefits of each, even if it means advising against a product that might offer a higher commission. This aligns with the ethical principle of putting the client first and regulatory requirements that mandate suitability and disclosure. An incorrect approach would be to proceed with the client's preferred, but potentially unsuitable, investment strategy without a comprehensive review. This fails to meet the duty of care and suitability requirements, potentially exposing the client to undue risk and violating regulatory mandates. Another incorrect approach is to recommend a product solely based on its commission structure, disregarding the client's risk tolerance or financial goals. This constitutes a conflict of interest and a breach of ethical conduct. Finally, pressuring the client to accept a recommendation that is not fully aligned with their needs, even if it seems beneficial in the short term, is unethical and can lead to regulatory sanctions. Professionals should employ a decision-making framework that begins with identifying the core ethical and regulatory obligations. This involves understanding the client's objectives, risk profile, and financial situation. Next, they should identify all available options that meet these criteria. A critical step is to evaluate each option for suitability, considering potential conflicts of interest and ensuring full disclosure of all relevant information, including fees and risks. The final decision should be documented and clearly communicated to the client, with the client's informed consent being paramount. Question 11. System analysis indicates that a long-standing client of Manulife Financial, who has previously invested in conservative, low-risk products, is now urgently requesting to invest a significant sum into a highly speculative, illiquid alternative investment fund. The client states they heard about this fund from a friend and believes it will provide rapid, substantial returns. The client is insistent on proceeding immediately, bypassing the usual review process. What is the most appropriate course of action for the Manulife financial advisor? Option A. Advise the client that Manulife Financial does not offer such products and suggest they seek advice from an independent advisor specializing in alternative investments. Option B. Proceed with the investment as requested by the client, given their long-standing relationship and insistence to maintain client satisfaction. Option C. Conduct a comprehensive assessment of the client's current financial situation, investment objectives, risk tolerance, and understanding of the proposed investment, while also performing enhanced due diligence on the fund and the source of funds, and then discuss suitable options with the client. Option D. Immediately decline the investment request due to its speculative nature and the client's history of low-risk investments, without further discussion. The correct answer is B. Proceed with the investment as requested by the client, given their long-standing relationship and insistence to maintain client satisfaction. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's perceived immediate need and the regulatory obligations of Manulife Financial to ensure suitability and prevent financial crime. The advisor must navigate the client's insistence on a specific investment product while upholding their fiduciary duty and adhering to anti-money laundering (AML) and Know Your Customer (KIC) regulations. The pressure to close a sale must be balanced against the imperative to protect both the client and the firm from potential harm. The correct approach involves a thorough and documented assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments, in conjunction with robust AML/KYC checks. This aligns with the regulatory framework that mandates financial institutions to act in their clients' best interests and to implement measures to prevent financial crime. Specifically, this approach ensures compliance with principles of suitability, which require that any recommended investment be appropriate for the client's circumstances. Furthermore, it upholds the firm's commitment to its ethical code and its responsibility to prevent its services from being used for illicit purposes. An incorrect approach that prioritizes the client's immediate request without adequate due diligence fails to meet the suitability requirements. This could lead to the client investing in a product that is not aligned with their risk profile or financial goals, potentially resulting in significant losses and regulatory scrutiny for Manulife Financial. Another incorrect approach, which involves proceeding with the transaction solely based on the client's stated desire without verifying the source of funds or the client's identity thoroughly, directly contravenes AML/KYC regulations. This exposes Manulife Financial to severe penalties, reputational damage, and the risk of facilitating financial crime. A third incorrect approach, which is to dismiss the client's request outright without exploring alternatives or understanding the underlying reasons for their insistence, demonstrates a lack of client centricity and may miss opportunities to educate the client or identify genuine needs that can be met through suitable products. Professionals should employ a structured decision-making process that begins with understanding the client's request and then systematically assessing it against regulatory requirements and ethical principles. This involves active listening, probing questions to uncover underlying needs and motivations, and a commitment to thorough documentation of all interactions and decisions. When a request appears to conflict with regulatory obligations, the professional should seek to understand the conflict, explore compliant alternatives, and if necessary, escalate the matter for further review or decline the transaction with clear, reasoned explanations. Question 12. Cost-benefit analysis shows that launching a new, complex structured product by Manulife Financial could significantly boost short-term revenue. However, the product's intricate nature means that a substantial portion of potential clients may not fully grasp its risk profile or potential downsides without extensive, tailored explanations. Which approach best balances the company's financial objectives with its regulatory and ethical obligations? Option A. Focus marketing efforts on the potential high returns with a brief mention of risks in the fine print to maximize initial sales and revenue. Option B. Proceed with the launch, relying on standard product disclosure statements and general risk warnings, assuming clients will seek clarification if needed. Option C. Prioritize a comprehensive client education and disclosure process, ensuring all potential investors receive clear, detailed explanations of the product's risks, benefits, and suitability criteria, even if it slows down the initial launch and revenue realization. Option D. Delegate the responsibility of understanding the product's complexities entirely to the sales team, assuming they will adequately inform clients. The correct answer is C. Prioritize a comprehensive client education and disclosure process, ensuring all potential investors receive clear, detailed explanations of the product's risks, benefits, and suitability criteria, even if it slows down the initial launch and revenue realization. Explanation. This scenario presents a professional challenge because it requires balancing the potential financial benefits of a new product launch with the ethical and regulatory obligations to ensure customer understanding and suitability. The pressure to innovate and capture market share can sometimes overshadow the imperative to act in the best interests of clients, especially when dealing with complex financial products. Careful judgment is required to navigate this tension and uphold Manulife Financial's commitment to its customers and regulatory compliance. Correct approach involves prioritizing a thorough and transparent disclosure process that ensures clients fully comprehend the risks and benefits of the new investment product before making a decision. This aligns with the fundamental principles of client protection and fair dealing, which are cornerstones of financial regulation. Specifically, it adheres to the regulatory framework that mandates clear, accurate, and not misleading information be provided to clients, enabling them to make informed investment choices. This approach demonstrates a commitment to ethical conduct by placing client interests above potential short-term gains from a rapid product rollout. An incorrect approach that focuses solely on the potential revenue generation without adequately addressing client comprehension would fail to meet regulatory standards. Such an approach risks misrepresenting the product's characteristics, leading to unsuitable investments for clients and potential regulatory sanctions for Manulife Financial. Another incorrect approach that relies on generalized risk warnings without specific details tailored to the product's unique features would also be deficient. This lack of specificity can obscure critical information, leaving clients vulnerable to unexpected losses and violating the duty to provide adequate disclosure. Furthermore, an approach that assumes client sophistication without verification or tailored education would be ethically unsound and potentially non-compliant, as it abdicates the responsibility to ensure genuine understanding. Professionals should employ a decision-making framework that begins with identifying all relevant regulatory requirements and ethical considerations. This should be followed by an assessment of the potential impact on clients, considering their individual circumstances and understanding. The chosen course of action must then demonstrably satisfy both regulatory obligations and ethical duties, ensuring that client interests are paramount. This proactive and client-centric approach mitigates risks and fosters trust, which are essential for long-term success in the financial services industry. Question 13. Process analysis reveals that a long-standing Manulife Financial client who has previously expressed a strong interest in a particular high-risk, speculative investment product is now requesting to invest a significant portion of their portfolio into this specific product. The client is insistent and has indicated they understand the risks involved. As a Manulife financial advisor, what is the most appropriate course of action to ensure compliance with regulatory requirements and ethical obligations? Option A. Politely decline the client's request, stating that Manulife Financial does not offer such high-risk products. Option B. Proceed with the client's requested investment immediately, acknowledging their stated understanding of the risks. Option C. Advise the client to seek independent financial advice before proceeding with the investment. Option D. Conduct a thorough review of the client's overall financial situation, investment objectives, and risk tolerance to determine if the requested product is suitable, and if not, explain why and propose suitable alternatives. The correct answer is B. Proceed with the client's requested investment immediately, acknowledging their stated understanding of the risks. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment product and the advisor's fiduciary duty to ensure suitability based on the client's comprehensive financial situation and risk tolerance. Manulife Financial, as a regulated entity, must prioritize client interests above all else, adhering strictly to the regulatory framework governing financial advice. The challenge lies in navigating the client's persuasive influence while upholding professional integrity and regulatory compliance. The correct approach involves a thorough needs analysis and suitability assessment before recommending any product, even if the client expresses a strong preference. This aligns with the core principles of client-centric advice, emphasizing that recommendations must be tailored to the individual's circumstances, objectives, and risk profile. Regulatory bodies mandate that financial advisors act in the best interests of their clients, which necessitates a deep understanding of their financial situation, investment objectives, and capacity for risk. Recommending a product without this due diligence would be a breach of this duty, potentially exposing both the client and Manulife to significant risks and regulatory sanctions. An incorrect approach would be to immediately proceed with the client's requested product without further investigation. This demonstrates a failure to conduct a proper suitability assessment, a fundamental regulatory requirement. Prioritizes client demand over client well-being and regulatory obligations, potentially leading to unsuitable investments that could result in financial harm to the client and reputational damage to Manulife. Another incorrect approach would be to dismiss the client's request outright without attempting to understand the underlying reasons for their interest. While suitability is paramount, professional advisors should engage with the client to explore their motivations and educate them on alternative options that might better meet their needs, rather than simply refusing to consider their stated preference. This approach lacks client engagement and could alienate the client. The professional decision-making process in such situations should involve a structured approach. First, actively listen to and understand the client's stated needs and preferences. Second, conduct a comprehensive fact-finding exercise to gather all necessary information regarding their financial situation, objectives, risk tolerance, and investment knowledge. Third, analyze this information to determine suitable investment options that align with the client's best interests. Fourth, present and explain these suitable options, including any potential risks and benefits, and address any concerns the client may have. Finally, document the entire process, including the rationale for the final recommendation, to ensure transparency and compliance. Question 14. The evaluation methodology shows that Manulife Financial's risk assessment process requires a comprehensive understanding of potential threats. When conducting a risk assessment for a new product launch, which of the following approaches best demonstrates adherence to robust risk management principles and regulatory expectations? Option A. Focusing primarily on risks associated with the most visible or recent market disruption, as these are likely to be the most significant. Option B. Assessing each risk in isolation, without considering how it might interact with other existing or potential risks within Manulife Financial. Option C. Prioritizing risks based on their potential impact and likelihood, supported by documented analysis and a clear rationale for each assessment. Option D. Relying on informal discussions with key stakeholders to gauge potential risks without formal documentation. The correct answer is C. Prioritizing risks based on their potential impact and likelihood, supported by documented analysis and a clear rationale for each assessment. Explanation. The evaluation methodology shows that assessing risk is a core competency for professionals at Manulife Financial. This scenario presents a challenge because it requires balancing the need for comprehensive risk identification with the practical constraints of time and resources, all while adhering to regulatory expectations for robust risk management. Professionals must exercise sound judgment to ensure that critical risks are not overlooked due to expediency. The correct approach involves a systematic and documented process for identifying and assessing risks, ensuring that all relevant areas of Manulife Financial's operations are considered. This aligns with regulatory frameworks that mandate a proactive and thorough approach to risk management, requiring firms to establish and maintain effective systems and controls. By prioritizing risks based on their potential impact and likelihood, and by documenting the rationale for these decisions, professionals demonstrate due diligence and compliance with supervisory expectations for risk oversight. This methodical approach ensures that resources are allocated effectively to manage the most significant threats to the firm's objectives and financial stability. An incorrect approach that focuses solely on high-profile or recent events would fail to capture a broader spectrum of potential risks, including emerging threats or systemic issues that may not yet be widely apparent. This oversight could lead to regulatory breaches if it results in inadequate controls for material risks. Another incorrect approach that relies on anecdotal evidence or informal discussions without a structured assessment framework lacks the rigor and objectivity required by regulators. This can lead to inconsistent risk identification and an inability to demonstrate a comprehensive understanding of the firm's risk profile. Finally, an approach that neglects to consider the interconnectedness of different risk types, e.g., Operational market credit would present an incomplete picture of Manulife Financial's overall risk exposure, potentially leading to misallocation of resources and an inability to manage complex, multifaceted risks effectively. This fragmented view is contrary to the integrated risk management principles expected by regulatory bodies. Professionals should adopt a decision-making framework that begins with understanding the firm's strategic objectives and risk appetite. This is followed by a structured risk identification process that considers all business units and activities. Risks should then be assessed based on defined criteria, e.g., impact, likelihood, and prioritized. The rationale for risk assessment and prioritization must be clearly documented, and the findings should inform the development of appropriate mitigation strategies and controls. Regular review and updates to the risk assessment process are crucial to adapt to changing internal and external environments. Question 15. Upon reviewing a client's financial profile and stated retirement goals, a Manulife financial advisor identifies several investment products that could potentially meet these objectives. However, one particular product, while suitable, offers a significantly lower commission to the advisor and Manulife Financial compared to other options that are also broadly aligned with the client's risk tolerance, but may not be as precisely tailored to their specific long-term needs. The advisor is aware of internal performance metrics that favor higher commission products. What is the most appropriate course of action for the Manulife Financial advisor? Option A. Recommend the product that most precisely aligns with the client's stated financial goals and risk tolerance, regardless of the commission structure. Option B. Select a product that is generally suitable and aligns with the client's risk tolerance, but also offers a more favorable commission for the advisor and Manulife Financial. Option C. Prioritize recommending products that offer higher commissions to the advisor and Manulife Financial, as these are often designed to be competitive and beneficial. Option D. Focus on recommending products that are heavily promoted internally by Manulife Financial, assuming these are the most advantageous for clients. Correct answer is A. Recommend the product that most precisely aligns with the client's stated financial goals and risk tolerance, regardless of the commission structure. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory compliance and the company's ethical obligations. The core difficulty lies in navigating potential conflicts of interest and ensuring that advice provided by a Manulife financial representative is objective and in the client's best interest, rather than being influenced by internal incentives or product biases. Careful judgment is required to uphold the trust placed in financial advisors and to adhere to the principles of fair dealing and suitability. The correct approach involves prioritizing the client's stated financial goals and risk tolerance above all else. This means conducting a thorough needs analysis and recommending solutions that are demonstrably the most suitable for the client's unique circumstances, even if they are not the most profitable for Manulife Financial or the representative. This aligns with regulatory frameworks that mandate acting in the client's best interest and upholding fiduciary duties, where applicable, ensuring transparency and avoiding conflicts of interest. Ethical guidelines also strongly support this client-centric model. An incorrect approach that focuses solely on maximizing commission or sales targets for Manulife Financial would be ethically and regulatorily unsound. This prioritizes the company's or representative's financial gain over the client's well-being, potentially leading to unsuitable product recommendations and a breach of trust. Another incorrect approach that involves recommending products based on internal marketing campaigns without a rigorous assessment of client suitability fails to meet the standard of care expected of financial professionals. This demonstrates a lack of due diligence and a disregard for the client's specific needs and objectives. Finally, an approach that overlooks or downplays potential risks associated with a product to secure a sale would be a serious ethical lapse and a violation of disclosure requirements, as clients must be fully informed of all relevant factors. Professionals should employ a decision-making framework that begins with a clear understanding of the client's objectives, financial situation, and risk appetite. This should be followed by a comprehensive evaluation of available products and services, considering their suitability, costs, and risks. Transparency with the client about potential conflicts of interest and the rationale behind recommendations is paramount. The ultimate decision should always be justifiable based on the client's best interests and in accordance with all applicable regulations and ethical standards. Question 16. Benchmark analysis indicates that a high net worth client of Manulife Financial has expressed a strong interest in a complex, illiquid alternative investment product that promises high returns but carries significant risks and has specific eligibility criteria. The client has provided documentation suggesting they meet some, but not all, of the stated eligibility requirements. The financial advisor at Manulife Financial is aware that this product is not typically recommended for clients with the client's stated risk profile, but the client is insistent and has indicated that a competitor has suggested they might be able to facilitate the investment. What is the most appropriate course of action for the Manulife financial advisor? Option A. Decline the investment outright, citing the client's risk profile and incomplete eligibility documentation, and offer a selection of more conventional, suitable investment options. Option B. Attempt to find a creative interpretation of the eligibility criteria or seek a waiver from the product provider to accommodate the client's request while still documenting the process. Option C. Recommend the client seek independent financial advice before proceeding with this specific product, while continuing to offer Manulife Financial's standard suite of compliant investment solutions. Option D. Proceed with the investment, documenting the client's insistence and any perceived gaps in eligibility to avoid losing the client to a competitor. The correct answer is D. Proceed with the investment, documenting the client's insistence and any perceived gaps in eligibility to avoid losing the client to a competitor. Explanation. This scenario presents a professional challenge because Manulife Financial, as a regulated financial institution, must navigate the complex interplay between client needs and regulatory obligations. The core difficulty lies in balancing the desire to provide a tailored solution for a high net worth client with the imperative to adhere strictly to the regulatory framework governing financial advice and product suitability. Misinterpreting or circumventing these regulations, even with good intentions, can lead to significant compliance breaches, reputational damage, and potential harm to the client. Careful judgment is required to ensure that any proposed solution is not only commercially viable, but also fully compliant and ethically sound. The correct approach involves a thorough due diligence process that prioritizes regulatory compliance and client suitability above all else. This means meticulously reviewing the client's financial situation, risk tolerance, and investment objectives against the specific requirements and limitations of the proposed investment product. If the product, despite its perceived benefits, does not align with the client's profile or regulatory guidelines, the professional must recommend alternative solutions or explain why the product is unsuitable. This upholds the principles of Know Your Client, KIC, and suitability, which are fundamental to maintaining client trust and adhering to regulatory mandates designed to protect investors. An incorrect approach that involves prioritizing the client's expressed desire for a specific product without adequate suitability checks fails to meet regulatory obligations. This could lead to a breach of the duty of care and potentially expose the client to undue risk, violating principles of fair treatment and responsible conduct. Another incorrect approach, such as attempting to bend the rules or find loopholes to accommodate the client's request, demonstrates a disregard for the integrity of the regulatory framework and ethical standards. This can result in severe penalties for both the individual and Manulife Financial, including fines, license suspension, and reputational damage. Furthermore, misrepresenting the product's features or risks to fit the client's profile is a clear ethical and regulatory violation, undermining the transparency and honesty expected in financial dealings. The professional decision-making process in such situations should follow a structured approach. First, fully understand the client's needs and objectives. Second, thoroughly research and understand the features, risks, and regulatory implications of any proposed product. Third, conduct a rigorous suitability assessment, comparing the product against the client's profile and all relevant regulations. Fourth, if a mismatch exists, explore alternative compliance solutions. Finally, clearly communicate the rationale for any recommendation or rejection to the client, ensuring transparency and adherence to all ethical and regulatory requirements. Question 17. The control framework reveals that a long-term Manulife Financial client, who has historically been risk-averse, is now requesting a significant reallocation of their portfolio into highly speculative investments, citing a recent conversation with a friend. As a financial advisor, what is the most appropriate course of action? Option A. Proceed with the client's requested reallocation immediately, as the client has the ultimate authority over their investments. Option B. Advise the client to seek a second opinion from another financial advisor before making any decisions. Option C. Politely decline the client's request, stating that their historical risk profile makes such investments unsuitable. Option D. Engage in a detailed discussion with the client to understand their motivations, explain the risks associated with speculative investments, and assess the suitability of such a chain based on their overall financial situation and objectives. The correct answer is A. Proceed with the client's requested reallocation immediately, as the client has the ultimate authority over their investments. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for that client to be unduly influenced or to make decisions that are not in their best long-term financial interest. The advisor must navigate this delicate situation by upholding their fiduciary duty and professional ethical obligations, which supersede a client's immediate, potentially ill-considered instructions. Careful judgment is required to balance client autonomy with the responsibility to provide sound, objective advice. The correct approach involves a thorough assessment of the client's understanding and the rationale behind their request, followed by a clear explanation of the potential risks and consequences. This aligns with the ethical principles of acting in the client's best interest, providing suitable advice, and ensuring transparency. Specifically, regulatory frameworks for financial advisors often mandate suitability assessments and a duty of care, requiring professionals to ensure that recommendations and actions are appropriate for the client's circumstances, objectives, and risk tolerance. This approach prioritizes the client's long-term well-being and adherence to regulatory standards designed to protect consumers. An incorrect approach that involves immediately executing the client's request without further inquiry would fail to meet the advisor's fiduciary duty. This could lead to the client suffering financial harm, which would be a breach of the duty of care and potentially violate regulations requiring suitability. Another incorrect approach, that of dismissing the client's request outright without understanding their motivations, could be seen as paternalistic and could damage the client relationship, potentially leading to a complaint or a finding of poor professional conduct, even if the advice itself was ultimately sound. It fails to engage with the client's perspective and explore the underlying reasons for their request, which is a crucial part of providing holistic advice. Professionals should employ a decision-making framework that begins with active listening and understanding the client's stated needs. This should be followed by a comprehensive assessment of the client's financial situation, objectives, and risk tolerance. The professional then uses their expertise to evaluate the suitability of the client's request against these factors and relevant regulations. If the request appears unsuitable or potentially detrimental, the professional must clearly and respectfully explain the concerns, outline the risks, and propose alternative suitable solutions. The ultimate decision should be a collaborative one, informed by the professional's guidance and the client's understanding. Question 18. Examination of the data shows that a client at Manulife Financial has expressed interest in an investment product. The available options include a proprietary investment fund managed by Manulife Financial, which offers a slightly higher commission to the advisor, and a comparable external fund with similar risk and return profiles. The client's financial goals and risk tolerance appear to be well matched by both options. What is the most appropriate course of action for the Manulife Financial advisor? Option A. Recommend the proprietary Manulife Financial Fund without explicitly mentioning its proprietary nature, focusing only on its features. Option B. Recommend the proprietary Manulife Financial Fund, ensuring full disclosure of its proprietary nature and any associated benefits to the advisor, and confirming it meets the client's stated needs and risk tolerance. Option C. Recommend the external fund solely because it does not present a conflict of interest, even if the proprietary fund is equally suitable. Option D. Recommend the proprietary Manulife Financial Fund due to the higher commission, assuming the client will benefit from the advisor's increased motivation. The correct answer is B. Recommend the proprietary Manulife Financial Fund, ensuring full disclosure of its proprietary nature and any associated benefits to the advisor, and confirming it meets the client's stated needs and risk tolerance. Explanation. This scenario presents a professional challenge because it requires an individual at Manulife Financial to navigate potential conflicts of interest and ensure compliance with regulatory obligations while acting in the best interest of clients. The core of the challenge lies in balancing business objectives with fiduciary duties and ethical conduct, particularly when proprietary products are involved. Careful judgment is required to avoid even the appearance of impropriety. The correct approach involves a thorough assessment of the client's needs and suitability of the product, independent of its proprietary status. This means prioritizing the client's financial goals, risk tolerance, and overall circumstances above the company's interest in selling its own products. This aligns with regulatory principles that mandate acting in the client's best interest and avoiding conflicts of interest. Specifically, under relevant financial services regulations, advisors have a duty to recommend products that are suitable for the client and to disclose any potential conflicts of interest. This approach ensures transparency and upholds the trust placed in Manulife financial advisors. An incorrect approach that involves prioritizing the sale of Manulife Financial's proprietary product simply because it is available or offers internal incentives would constitute a failure to act in the client's best interest. This could lead to regulatory breaches related to suitability and fiduciary duty. Another incorrect approach, which is to downplay or fail to disclose the proprietary nature of the product and any associated benefits to Manulife Financial, would be a violation of disclosure requirements and could mislead the client. This undermines transparency and client trust, potentially leading to significant regulatory penalties and reputational damage for Manulife Financial. Professionals should employ a decision-making framework that begins with a clear understanding of client needs and regulatory obligations. This involves a systematic process of needs analysis, product evaluation based on suitability criteria, and full disclosure of any potential conflicts. If a proprietary product is being considered, the advisor must objectively assess if it is genuinely the most suitable option for the client compared to other available products in the market, and if so, clearly articulate why. This ensures that decisions are client-centric and compliant. Question 19. Assessment of how a Manulife financial advisor should proceed when a client is considering an investment product that the advisor personally benefits from through a referral fee, but this benefit has not been disclosed to the client. Option A. Disclose the referral fee to the client and explain how it might influence their decision, allowing the client to make an informed choice. Option B. Proceed with the recommendation, as the referral fee is a personal benefit and not directly related to the client's investment performance. Option C. Recommend a different similar product that does not offer a referral fee to avoid any perception of conflict of interest. Option D. Proceed with the recommendation, assuming the client will benefit from the investment regardless of the undisclosed referral fee. The correct answer is B. Proceed with the recommendation, as the referral fee is a personal benefit and not directly related to the client's investment performance. Explanation. This scenario presents a professional challenge for a Manulife financial employee due to the inherent conflict between client interests and potential personal gain, amplified by the need to adhere to strict regulatory requirements. The employee must navigate a situation where a client's financial well-being could be inadvertently compromised by a recommendation influenced by an undisclosed personal benefit. Careful judgment is required to ensure that all actions are transparent, ethical, and compliant with Manulife's internal policies and relevant financial regulations. The correct approach involves prioritizing the client's best interests above all else, and ensuring full transparency regarding any potential conflicts of interest. This aligns with the fundamental principles of fiduciary duty and ethical conduct expected of financial professionals. Specifically, regulations such as those governing conduct in financial services require individuals to act with integrity, skill, care, and diligence, and to avoid conflicts of interest or manage them appropriately. Disclosure is paramount. Failing to disclose a personal benefit that could influence a recommendation is a direct violation of these principles and can lead to severe regulatory sanctions and reputational damage. An incorrect approach would be to proceed with the recommendation without disclosing the personal benefit. This failure constitutes a breach of trust and a violation of regulatory obligations that mandate transparency and the avoidance of conflicts of interest. It prioritizes personal gain over client welfare, which is ethically unacceptable and legally prohibited. Another incorrect approach would be to subtly steer the client towards the product without explicitly mentioning the personal benefit, hoping the client would not inquire further. This is a form of deception and still fails to meet the disclosure requirements, undermining the client's ability to make an informed decision. Finally, an approach that involves downplaying the personal benefit or suggesting it is insignificant would also be incorrect, as any potential influence, however small, must be fully disclosed to the client. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. Once identified, the next step is to assess the nature and significance of the conflict. The paramount consideration must always be the client's best interest. If a conflict cannot be effectively managed or mitigated to ensure the client's interests are protected, the professional should decline to act or seek guidance from their compliance department. Transparency and disclosure are not optional. They are regulatory imperatives and ethical cornerstones of the financial services industry. Question 20. Which approach would be most appropriate for a Manulife financial team evaluating a potential expansion into a new international market, considering the need for thorough risk assessment? Option A. Initiate a comprehensive risk assessment process that identifies, analyzes, and evaluates all material risks, operational, financial, legal, reputational, etc., specific to the new market, involving cross-functional expertise and senior management oversight. Option B. Prioritize the assessment of financial risks only, as these are the most direct indicators of potential profitability and loss. Option C. Delegate the entire risk assessment to the legal department, trusting their expertise to cover all potential issues without further consultation. Option D. Conduct a rapid, high-level assessment focusing primarily on potential revenue projections and assuming that existing risk management frameworks are sufficient for the new market. Correct answer is D. Conduct a rapid, high-level assessment focusing primarily on potential revenue projections and assuming that existing risk management frameworks are sufficient for the new market. Explanation. This scenario presents a professional challenge for a Manulife financial employee because it requires balancing the company's strategic growth objectives with the imperative to conduct thorough and appropriate risk assessments. The pressure to expand into new markets, while potentially lucrative, inherently introduces new and potentially unknown risks that must be identified, evaluated, and mitigated before significant capital is committed. Failure to do so could expose Manulife Financial to substantial financial losses, reputational damage, and regulatory sanctions. The core of the challenge lies in ensuring that the risk assessment process is not merely a procedural hurdle, but a robust mechanism for informed decision-making, aligned with regulatory expectations and ethical responsibilities. The correct approach involves a comprehensive and proactive risk assessment that integrates market analysis with a detailed evaluation of operational, financial, legal, and reputational risks specific to the target market. This approach aligns with the principles of prudent risk management expected of financial institutions. Regulatory frameworks, such as those governing financial services firms, mandate that companies have robust systems in place to identify, assess, and manage risks. For Manulife Financial, operating within a regulated environment, this means demonstrating to regulators that all material risks associated with new ventures have been considered and appropriate controls are in place. This proactive stance ensures compliance with prudential requirements and safeguards the company's financial stability and the interests of its stakeholders. An incorrect approach that prioritizes speed over thoroughness would be professionally unacceptable. This could manifest as a superficial review of potential risks, relying on assumptions rather than data, or downplaying identified concerns to expedite the decision-making process. Such an approach would violate regulatory obligations to conduct due diligence and could lead to significant unforeseen losses. Another incorrect approach would be to delegate the entire risk assessment to a single department without cross-functional input or senior management oversight. This siloed approach risks missing critical interdependencies between different risk categories and fails to foster a holistic understanding of the risk landscape, potentially leading to a flawed assessment and inadequate mitigation strategies. A third incorrect approach would be to focus solely on financial risks while neglecting non-financial risks like regulatory compliance, operational disruptions, or reputational damage. This narrow focus is insufficient for a comprehensive risk assessment and exposes Manulife Financial to a wider range of potential harm that could have significant financial and strategic consequences. Professionals at Manulife Financial should adopt a decision-making framework that emphasizes a structured and iterative risk assessment process. This involves clearly defining the scope of the assessment, identifying all relevant risk categories, gathering data from reliable sources, analyzing the likelihood and impact of identified risks, and developing appropriate mitigation plans. Crucially, this process should involve input from various departments and be subject to review and approval by senior management and, where applicable, the board of directors. The framework should also include mechanisms for ongoing monitoring and review of risks once a decision to proceed has been made, ensuring that the risk profile remains manageable and that mitigation strategies are effective.